people mix cheap with value, and that's not the right way to do it. You buy first solvent companies, then you buy contrarian. You be more contrarian. First, you be sure that the company will survive. So a few years back, people used to ask me, how can you buy power companies, power PSUs, oil PSUs? How can you buy telecom? So when COVID hit us, for 18 months, we worked out of home using two things. The fact that the power connection at home, the telecom connection at home. Without the power connection at home and the telecom connection at home, I wouldn't have been able to work out of home for 18 months.
Hello, listeners. My name is Raj Singhal, and welcome to another episode of Breaking Investment Stereotypes. Here we deconstruct world-class investors or wealth managers and deep dive into their investing journey, professionally, personally, or both. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can find fellow investors, discover investing products, and share investing ideas. We have now gone live and thousands of users are already part of a vibrant community. So do check out our app, which is there both on Apple Store and Play Store, or simply just sign up on web. I want to give a little guidance on how to use these shows. None of the following should be taken as an investment advice. Please see multipie.co/disclosures for more information. My guest for today is S. Naren. Naren is the Executive Director and CIO for ICICI Prudential AMC. He oversees the entire investment function across the mutual fund and the international advisory business. He is instrumental in overall investment strategy, development, and execution. He manages the ICICI Prudential Dynamic Plan, ICICI Prudential Value Discovery, Balance Fund, and Multi-Asset Fund as well. Naren has rich experience of 30 years in almost all spectrum of the financial services industry, ranging from investment banking, fund management, equity research, and stockbroking operations. His core competency lies in being involved in the entire gamut of equity market space with extensive knowledge of Indian equities and the economy. After obtaining a BTech degree from IIT Chennai, Naren finished MBA in finance from IIM Calcutta and worked with financial services organizations like Refco, HDFC Securities before joining ICICI Prudential AMC. Naren has many laurels to his credits. He's the leading voice on the Indian economy, equity markets across investments, and financial services fraternity. So without further ado, please welcome S. Naren. Hey, Naren, welcome to the show.
Hi.
Naren, so we are, you're known as someone who focuses on value plus contrarian plus macro, right? Have you always been like this, or your own investing philosophy have changed over the years? And also maybe you want to touch upon the Chennai club you were part of.
Actually, in 95 to 98, I got hurt in equity. And when we got hurt in equity, you went and introspected as to why you got hurt in equity. The reason what we found was lack of value thinking, focus on momentum thinking in 94, 95 was the reason why we got into value investing. Then 2008, when we at ICICI Mutual Fund, when we saw investors lose money in our funds, again, we went into introspective thinking as to why we lost money for our investors. We realized that macro is responsible for that. Then in 2009-10, when we started becoming big, we realized that what is the learning that you have if you have to manage big money? What we realized was if you want to manage big money, you have to be contrarian. Because if you're managing big money, if you're contrarian, it's very easy to manage. So I would say these three things came out of what we needed. So value based on the mistakes committed in momentum investing in 94, 95 personally. 2008 based on the losses suffered by our investors, learned macro. I didn't know the word macro till 2008. If you had asked me what is current account deficit, what is fiscal deficit, what is all this NPL and banking problem and all that in 2008, I wouldn't have even known about it, mortgage problem, etc. So we learned it. So I would say it's the demands of the job and demands of managing other people's money which made me value contra and macro. And after that, the last 10 years, I have been a CIO of managing other people's money. I found that this combination of value, contra, and macro has helped us in managing other people's money. So we have stuck on to that. And that's why this has become attributed to ICICI Prudential, and I'm happy that it has struck on this.
That's awesome. So, I just want to pick up on macro. And I think in 2020, you said, and I'm just quoting from that stock markets are driven by fund managers. Global central banks, not actually driven by fund managers, global central banks control the market. The day the central banks decide to roll back the liquidity support, market can come down significantly. And now we are seeing that global setup, right? About 15 inflation was, of course, rolled back, especially in US and most of the developed markets. 15 to 20 central banks have hiked rates. I was just checking Brazil and Russia's policy rates are now higher than even pre-pandemic level. And of course, Fed is expected to hike rates very aggressively, right? Market is pricing in close to about 6 to 7 rate hikes just in this year. Do you, in that backdrop, do you see that as, something to really worry about?
Absolutely, a lot to worry about. And I believe that, in tune with what we told in 2020, if you see following that famous Fed statement in November 2021, it has been difficult to make money in any part of the world. China was the only market which corrected before that because Chinese central bank was always hawkish. And other than that, if you looked at it in any other part of the world, after that famous statement by Jerome Powell that inflation is not transitory, it's been impossible to make money in any other part of the world. And so I think till the time the central banks say that inflation is no longer a problem, or I'm going to start again pumping money on quantitative easing, it's going to be very tough to make money. And so the thesis that we see, in June, July, August 2020, we were very cautious. I was very cautious. I used to tell my colleagues in my company that we have to be cautious. And we were going wrong. So when we went wrong, we were thinking, why were we going wrong? Then we realized that actually we were looking like equity fund managers. Actually, we should think what the central banks were doing, and they were printing money as there was no tomorrow. Then we realized that that's no longer that we are not the people deciding anything, and it is only the central banks deciding everything. So what we decided was we will launch ICICI Prudential ESG Fund, we launch ICICI Prudential Quant Fund, ICICI Prudential Business Cycle Fund, ICICI Prudential Flexi Cap Fund, because we realized that the central banks are continuously printing money. So when we got approval from regulator, we immediately launched these funds. And that call worked because it is the central banks who are printing money and causing everything to go up, including commodities. And that call actually played out till the Fed said transitory inflation is over. Actual inflation has come back. Now we have to act against it. And after that, you notice no one has been able to make money. Impossible. If you look at it, anyone who said, okay, on the day they said, Fed said, if you had moved to cash, you would have been better off maybe.
So talking about inflation, and we've seen commodity prices going up a lot, right, including oil. But if you look at the recent RBI statement, and most of us were surprised that they didn't do anything, and probably the reason was that because they are now forecasting inflation to go down to about 4.5%. How do you see this whole commodity prices, inflation, especially from the equity market point of view?
I think the Reserve Bank of India is a very, very complex and very intelligent central bank, and I don't have any right to talk about the central bank. But I would say that the central bank in India has been very, very, very thoughtful. Last year, they bought so much of dollars. Because they bought so much of dollars, today we have got no problems. If you look at it, last month, they did some selling of bonds. So while they were dovish, they sold a lot of bonds about a few months back. So if you look at it, they have been slowly taking out money out of the economy through VRRR, a new model that they came up with. So while they are dovish, they have done a lot of things. Bought a lot of dollars, done some amount of quantitative tightening. They have removed a lot of money from the economy through VRRR. So I would say that the central bank in India is one of the most intelligent central banks in the world, because they have not done thoughtless QE and created so much of surplus, QE like what many other central banks in the world has done. So I would say that we don't look at only one statement of Reserve Bank. We look at all the things that the central bank does and the government does, and we have found them that they know what they are doing, and we have to accept that.
But this whole inflation and the high commodity prices, some of them actually benefit equity markets, but oil is a big macro issue for India. But how do you see this whole commodity-led inflation impacting India for now, at the Indian equities?
See, one of the things that we learned over a period of time at ICICI Prudential is that when oil goes up, equity market doesn't come down. If you go back and study history, 2004 to 8, oil went up, equity market went up. 2009 to 14 also, equity market went up along with oil. So it's only when oil comes down, equity market comes down in India. I don't know why. It's only fixed income interest rates go up when oil goes up. So I would say that, somehow Indian equity market and oil is correlated in a positive way, at least till one point of time, maybe till 100 or something like that. So we're not really that worried about it. We are worried that valuations is too high, but we are not in the equity market. Somehow what happens, I feel, is that these national oil countries, they get current account surplus and they redeploy that money into countries like India as oil goes up above a certain level. And due to that, I feel that equity market does not go down too much because of oil going up. That's what I feel. Having said that, I think the time for easy monetary policy is over. If you look at last year, because RBI pumped a lot of rupees in the economy when they bought dollars, the economy became very surplus on liquidity. No longer is RBI going to be able to buy dollars. So if they're not going to be able to buy dollars, they're not going to be able to release rupees into the economy. They may be forced to sell dollars. If they sell dollars, they will release rupee from they'll remove rupee from the economy. And that is going to tighten the entire monetary conditions in the economy. So we are not where we are in 2020 and the first half of 2021. We are in a much, much tighter liquidity environment. That also will lead to volatility in equity markets over the period from now on. And we are not going to see what we saw between March 2020 and November 2021.
Okay. So one thing I want to talk about, your whole approach to asset allocation, and you've been running one of the most successful multi-asset fund over the years. And I was actually looking at the results, and it's very impressive results since inception, right? So how much of your thinking around multi-asset approach is driven by asset allocation strategy or to avoid hubris? Tell us more about this whole multi-asset approach.
Again, this came out of 2008 global financial crisis. Investors invested aggressively in 2007. Post 2008 lemon event, not 1 rupee came into our fund house till 2009 May. So introspection told us that we have to create products where when the money comes, we keep it aside for a rainy day and invest when markets fall. So we work very hard to create strategies where money is collected but not invested immediately in equity. So we created those strategies which are asset allocation products. And through that route, what happened was we started working on them. Actually, I didn't expect my sales team to be successful in collecting such products. Because in India, there's a belief equity will always outperform debt. But what happened was, thanks to 2011 Europe problem, 2013 taper tantrum, 2015 China problem, then you had Demon, then you had GST, then you had ILFS, okay, then you have had COVID. You have had events periodically which showed that a model which involves debt also can deliver returns to the investor in a good risk-adjusted way. That today the entire mutual fund industry has followed us into asset allocation. So what we realized is something which may not work instead has become commonplace. Everyone has got into that whole framework right now, and it has worked. And I'm very happy that investors are focused. But what we believe is today we should have products which involve equity, debt, and gold. We should have products which involve equity, debt, gold, global investing. And we have to broaden that product and actually have more interesting products also. And that is the framework that we've been working on, because end of the day, what has happened when we started a product in 2010, debt used to give us very, very good returns. Today, if you invest in debt, even in India, the returns are very, very low. So net of expenses, the returns that you get on the debt component is pretty low. So that is why the challenge is that we have to mix more products and hope that by mixing more products, we can get a better return, hopefully to the investor. Because otherwise, in 2014-15, if you invested in a government bond, you could get 8-9%. Yeah. Today, that is ruled out. And that is the interesting aspect.
Okay. So you mentioned a couple of the asset classes, equities, debt, gold, probably, you didn't mention real estate, but you can throw in real estate as well into that, and global investing. You want to share your thoughts, views on each one of them right now? Where do you stand in terms of your thought process?
See, real estate, physical real estate is outside the domain expertise of ICICI Prudential Mutual Fund, although as an asset management company, we are involved in it. I think, for a long period, I used to tell people that real estate was an overvalued asset class. But after 2020, when mortgage loan interest rates fell in India, I changed my mind. I think today it's because interest rates on home loans are so low, it seems to be, at least for self-use, a much more interesting asset class than it was in the 2013 to 19 cycle. Clearly, for self-use, it does make sense because interest rates are so low compared to what we've seen. So there, we've used a metric, which is home loan interest rate minus rental yield. So people always worry about valuation. So I tell them, look at this metric. This metric is an indicator of valuation. So if home loan interest rate minus rental yield is very high, it means that the valuation is high. On the other hand, if home loan interest rate minus rental yield is low, then valuation is low. So go back to 2015, home loan interest rates are much higher. Rental yield was almost the same. So actually from 2015 to 2021-22, actually valuations have fallen in real estate. So that's how we look at it. And even in 2003, if you look at it, home loan interest rate minus rental yield was very attractive at that point of time. So this is the metric I tell people to use, because people keep asking me, how do I define real estate valuation in a country? And on that basis, I know that you could have always bought in many of the world for self-use. I agree, but it's not a bad idea because rental yield was always much higher than home loan rates in US and many other parts of the world. So for self-use, it was always worthwhile to buy in many parts of the world. But as far as gold is concerned, it has become very complex because most of my classmates in US, they all have gone into this crypto. Crypto competitor of gold in other parts of the world. I have no idea there. But my reading is that whenever all other asset classes in the world are costly, there is no harm in putting some money in gold. Whenever all other asset classes are cheap, don't invest in gold. This was one framework which I used to convey to people some time back, that gold is a residual asset class. So if you find other asset classes cheap, don't invest in gold. But if you find all other asset classes costly, invest in gold. So on that basis, in recent times, it's not a bad idea to put some money in gold, because neither was debt cheap, neither was equity cheap, neither. So no asset class in the world looked cheap. So you can put some money in gold. That is how we have. That is how we look at gold. The way I look at gold is based on other asset classes. Because gold, as Warren Buffett says, doesn't give either interest or dividend. How do you look at gold? So look at it from the prism of other asset classes. If you can find any other cheap asset class, don't invest in gold. That is how I tell people these days. So now it's okay because other asset classes are not that cheap. So put some money in gold.
Do you want to specifically touch upon Indian equities and global equities as well in terms of overall framework and view?
All our models which we use in our asset allocation funds say that equities in India are not cheap. And that is what all the models that we are using says that. So global equities, clearly if you look at Japan, if you look at Europe, and if you look at value equities or cyclical equities in US, they all look reasonably valued. And these are the areas clearly which look reasonably valued at this point of time. So in my value fund, for example, I pick some telecom stocks in the world. And, people told me, how will you make money in telecom stocks? I was very surprised that one of the telecom stocks I picked up in Europe, it was the only stock which went up 15% in this last 3 months. And it was such a pleasant surprise to me because for 5 years, it had delivered huge negative return to investors. So I believe that, there are cheaper stocks in the world because somewhere in this last 5 years, people have bet on only extreme growth companies in US. So if you exclude the extreme growth companies in US, many of the cyclical value stocks in US and Japanese and European stocks certainly look okay. And, if you want to read an extreme write-up, you can always read the GMO write-up. I think that he has written it in a much more extreme way that I cannot, I don't have the knowledge base to write it. But I would say that's how I look at it at this point of time.
Okay. I want to touch upon, this whole value investing, right? I mean, the thing about value investing is also one thing which is associated with value investing is value trap as well. And if you look at globally, one of the market which has been viewed as a value trap is European equity markets, for the last 10 years been viewed as a value trap. And even Japan, I mean, as the equities have not really done very well over the years, if you see. How does one, while looking at this whole value investing, avoid the value trap?
So, in India, which is my base country, I've come to a conclusion that you have to do contrarian investing more than value investing. Okay. And if you're not going to get good dividend yield on your investment, or you're not going to have very good free cash flow yield on your investment, don't look at it. You can't do value investing in leveraged companies. This was something, one of the reasons I would say I survived as a fund manager is I didn't buy infrastructure construction companies in 2007-8 saying it's cheap in 2008 when they fell because they all went bankrupt. Or I didn't buy private sector power companies saying they are very cheap. So I would say, people mix cheap with value. And that's not the right way to do it. You buy first solvent companies, then you buy contrarian. You be more contrarian. First, you be sure that the company will survive. So a few years back, people used to ask me, how can you buy power companies, power PSUs, oil PSUs? How can you buy telecom? So when COVID hit us, for 18 months, we worked out of home using two things. The fact that the power connection at home, the telecom connection at home. Without the power connection at home and the telecom connection at home, I wouldn't have been able to work out of home for 18 months. So I said, these are not value traps. If I'm able to do my entire job out of power and telecom, how can telecom and power be value traps even if for 10 years they haven't delivered? So I was very confident it's not a value trap. So I bet even more strongly on them, saying that my entire work is happening due to these two sectors. And suddenly they both have worked very, very well for me. So I think you have to ask yourself, are you using that product? Peter Lynch style. Are you convinced that you will continue to use that product? So that was very clear in telecom. It was very clear in power, with electric vehicles becoming the order of the day. So then the moment COVID ended, I realized that we have to make use of our cars also. And you don't have a substitute to oil in the next 3 years. So we said oil is also not a value trap in the near term. Maybe it's a value trap with a 10-year view. So I believe that one of the ways in which we look at value traps is, are you convinced with the product? So if you're going to bet on let's say a landline phone, then it's a value trap, because none of us are going to go back to a landline phone. So I believe that you have to ask yourself a question. Are you going to open an account in certain banks in this country? If you're not going to use open bank accounts, so when people ask me, is this stock a value trap? I ask them, are you going to open a bank account in that bank? If they tell me they're going to open a bank account in that bank, I tell them, no, it's not a value trap. If they say, no, I want you to open a bank account in that bank, then I tell them it's a value trap. So I believe Peter Lynch style thinking sometimes works very, very well in identifying value traps, because the moment you're using a telecom and you're using power and you're using oil, it can't be a value trap. Particularly if it is very, very cheap. That's the Peter Lynch test is much better than any other test in our opinion.
Yeah. So I want to pick one sector, talking about this whole value investing, and which is metals, right? Initially did very well, but then off late, last 3, 4, 5 months, it's kind of stagnated. And I was looking at the PAT for the quarter, right? So metal has done double the profits of the consumer sector, but of course trades at much lower multiple based on the market cap. And of course there has to be a cyclicality discount on that. But how will you look at this whole metal industry from this whole value point of view?
A very complex sector. It's a sector which I've tracked for 15 years. And I later realized that China controls everything. So when China sneezes, the sector goes down like one rocket. On the other hand, one day China will come and give one statement. Everyone will feel so happy. The sector will just go up like a rocket. What I realize is that you cannot you can buy a stock based on price to book. And then you have to take a call, what will China do next? And you cannot act based on what China says. You have to take a call that this is what will happen next in China. And it involves very good guesswork. And I believe Chinese policymakers are the smartest people in the world. They know how to moderate iron ore prices. They know how to moderate steel prices. They know how to moderate every commodity in the world. So in our framework, if steel prices go down very low, we buy steel stocks. If steel prices go up very high, we say, let's sell steel stocks. So that model I've seen, if iron ore goes down too low, buy iron ore stocks. If iron ore goes up too high, sell iron ore stocks. And this framework we have seen has worked very much better for us than saying was, today China has said this, so let's buy. That model doesn't work. So, over a period of time, we believe that behavioral finance and temperament works much better in metal investing than doing deep analysis of what China is doing today. And in that framework, I would say that at ICICI Prudential Mutual Fund, we made very good alpha over a period of time.
Okay. The other sector I want to pick up, and where probably China will not have much of an influence, is banks, right? I mean, so I guess you guys have a very large allocation to tier 1 banks and some within that PSU banks as well. Now there is a school of thought with this whole fintech coming in. I think you touched upon previously as well, and shift in technology. What will happen to banks? People are, saying many things, right? What is and on the other side, that of course right now the credit growth is still very muted, but expected to go up. I personally think it will go up because I think the capex cycle has started, and probably people will borrow money from banks. What is your thesis right now on this whole, you guys being positive on bank? What is driving that?
See, cyclically credit growth picking up, lack of a NPL cycle, and so many years of underperformance are a positive. Structurally, what to do, we are not clear. But cyclically, things certainly look better. The problem with the sector comes differently. The problem is if there's, let's say, 10,000 crore of redemption, people will have to sell 3,000 crores of bank stocks. Yeah. That is a bigger problem for me than the cyclical positive. So my big worry is if you take the September to November period, FIs had so much of banking holdings that when they had to do redemption, they had to sell banking stocks. So my worry comes out of not the over ownership, the ownership itself, that every fund in India has 30% in banking. So if you're going to have redemptions, people are going to sell banking. If people are going to have inflows, people will buy banking. But periodically, there are so many fundraisers which keep happening in the sector that whenever inflows come, many of these brilliant investment bankers find some fundraising to do in some bank or the other. So that's why the appetite of the investor is always taken care of. So that's why I would say that, I'm more worried about redemption and inflow cycles. But cyclically, I'm positive. Okay. And at ICICI Prudential, I think we have been cyclically most positive at this point of time because we see the combination of credit growth and no problems of NPL outside, at this MFI and those kind of areas. For the first time, the combination of the two at the first time. And last 2 years, credit growth has been so low. Then from here, credit growth has to go up. It is like, oil last year, oil had to go up. Like that, credit growth has to go up from here.
And within that, are you more positive PSU versus private, or are you just generally positive on the sector?
We are positive on the banks with the best CASA and the banks with the best technology.
Okay. I got it. Let's talk about the whole retail participation in the stock market, right? I mean, we are seeing a lot of SIP flows coming to the mutual fund, and it's very heartening to see numbers have grown up to about 11,000-12,000 crores a month. It's a large sum of money. So much so that now market doesn't need to worry about FI's outflow. What do you think about this whole SIP flow? There is a more structural thing to that will stay on. So that is one question regarding retail. The other thing I want to ask is that, retail is of course coming directly as well into the market and, making large allocation to small and mid cap. What do you think of that behavior, especially for the small and mid cap? So both SIP and the small and mid cap, I want to ask you.
I think the SIP flows are a very big positive. And I think the fact that investors have been steadily investing over the many years is a big positive. And the problem is, do the investors know the risks of equity market? I was a stockbroker between 94 and 2004 in my career. And I noticed at that point of time that many investors didn't understand the risks. Do the current investors also understand the risks? Do they understand the downsides? Do they know what they are buying? These all are my concerns. And in my reading, those are all problems we'll come to know if there is a meaningful correction. And having seen 95 to 98 and 2001 too, I'm deeply worried about that issue. Although things like SIPs are very positive. I think that part of it is very positive. There again, people can't withdraw from SIPs when the markets fall. If you don't do SIPs when the markets fall, then there's no point in doing SIPs. SIPs have to be done when the markets fall. They can't be done when markets are high. Then otherwise you're averaging markets upward. So that is the challenge at this point of time. Overall, it's a positive development. But I would say that we have not yet been tested to see whether that in a big market correction and if the correction stays, because after 2012, the central banks across the world haven't allowed any market corrections. They ensure that markets go up immediately. So we'll have to see whether this time the global central banks will again allow a market correction to sustain, or again they'll manage to push it up again. So is there something called a Fed put or not? That's something we have to see.
Yeah, and then more importantly, at what level the Fed put is there. So that is also equally important.
Yeah.
Uh, Talking about the insurance companies, right? I mean, and we have seen that they used to trade very expensive, but off late have fallen or continue to fall, I would say. And I think I saw that you guys have been increasing allocations, especially the life insurance, the companies in the fund. What's your overall thesis, especially in the view of the upcoming LIC IPO, which is going to happen in the market soon?
I can't talk on the IPO, but overall, we believe that, it's another sector where gradually investors have been investing. And I believe that insurance is again a long-term trend. India is a country where protection has not seen much of inflows. We believe that over the next 10, 20 years, protection is going to see a fair amount of action, and lot of scope exists, particularly in protection. And we think all the life insurance companies will focus on protection and actually raise a lot of policies in that area. So that's how we look at it.
Okay. You touched upon real estate, but I want to talk a little bit deeper into that, right? So you made actually a couple of contrarian calls on real estate. One was in, I think, 2012, when you said that real estate companies or real estate itself is very expensive. And again in 2019-20, when you said the real estate is becoming cheaper enough. What's the overall thesis right now on the real estate as a sector, or real estate companies from the stock market point of view?
So from a stock market point of view, the addressable market cap in India is not that big, because still we don't have many companies that we can bet on to the same level, because still a lot of it is difficult to bet on companies which are still operating, which are not listed also. So I believe that, the listed companies are few, and some of them did raise money in 2007-8 and did not conduct themselves properly on the corporate governance side. So they just withered away. So it is not as big a sector as what it would be. But I think so far all the REITs which have been listed, they have conducted themselves much better. So I think what can happen over the next 5 years is more number of REITs get listed. And because the REITs which have been launched have all delivered a reasonable experience in the first 3 years. And I believe that it's possible that more REITs may come, and that may be a model which can actually become bigger than real estate companies per se. That's what it looks at this point.
Okay. So I want to mention three people who, I was listening to one of your another talk, and you mentioned about Howard Marks, Michael Moboshin, and Montier, who had got a reasonable influence in terms of, or shaping the way you see the world of investing. Talk more deeper about them. I mean, what part of their philosophy thinking has more influenced you?
See, when Montier's 10 tenets of investing I read, I realized that just reading that again and again and again and ensuring that I follow it would itself ensure that I'll manage other people's money well. So once in 6 months, I read it and say, am I following it? Am I not following it? See, one of the biggest aspects, what I learned in investing, and I keep telling my colleagues at ICICI Prudential, you don't need newfangled theories. You need to follow the theories faithfully and not break the theories at the wrong points in the cycle. And in my reading, frankly, that is very important. Howard Marks taught me cycles. And without knowledge of cycles, I would not have been able to understand what to do in this entire period. From what happened in 2007, 8, 9 became clearer after reading Howard Marks. And Michael Mobesson helped in taking a lot of decisions, because you have to do pre-mortems. See, as a country or as individuals, we always do post-mortems, and post-mortems are always blame games.
Yeah.
The moment you do pre-mortems, they are not blame games. You ask yourself, what can go wrong? Instead of what has gone wrong. The moment it is what has gone wrong, we are only blaming each other. If you ask yourself, what can go wrong? then what happens in this whole process is the discussion is much more constructive. The moment is what has gone wrong. We are trying to identify who's the person responsible for going wrong. And that too, when you're managing ICICI Prudential AMC's investment process, it is wise to have a situation where you're trying to find out what can go wrong. Otherwise, all the time you'll be trying to find out who's responsible for what mistake in my department. So, and you're managing other people's money. So continuously, we are trying to do pre-mortem of what can go wrong.
Okay. I like this statement you made, right? Investing is about buying, sizing, and selling, right? So, irony that 98% of investment literature in India is basically about what to buy, right? But only very small part of people talk about sizing and selling. So maybe I want to talk deeper about, the aspect of sizing and of course the aspect of selling as well.
So actually, in the first, when we went back and looked in 96, 97, what we realized is many of us had created what I call a zoo. Okay. And I said zoo, which means that you all create zoos, which means we buy so many things that we don't know what we have bought. And we buy so many things that finally at the end of the day, if you look at it, we have lost control of what we have bought.
Yeah.
So this whole concept of sizing comes from the fact that, you have to buy some things in a particular scale for you to make a meaningful impact on portfolio. If you look at most of the investors in the country, you will find so many things that, you don't know what you bought. But the moment you're sized, what happens is you have done much better work. Outcome is much better. Because you've done much better work and then you've bought much more of something. It's much easier for me. But if we have bought at ICICI Prudential 9% of a company, we better not go wrong. So I believe that the sizing aspect is absolutely very, very important, and very, very, very few people are focused on it, particularly in the initial parts of their investing career. It is only later they realize that if they don't size, they create a zoo.
Yeah, true. We always get fascinated by talking that next decade belong to India, right? So we always been generally bullish that, apna time aa gaya hai and all of those things, right? But what do you think from the coming decade, right? We bullish about PLI and CAPEX and a lot of things being talked about. What do you think?
No, I'm trained to look at cycles, much less trained to look at such very big structural trends. So what is the learning I have is, if there is a period of time when I see excessive pessimism, I look for that point of time at a very optimistic story. And at a time of excessive optimism, I talk pessimistic. Okay. So this is how I'm trained to think. So when people say next 10 years, next 15 years, next 20 years, people tell me, I tell them, you do asset allocation, you will make money. In March 2020, we tell people this is a time to invest very aggressively. And that is there in media if you check.
Yeah, I'm sure. Yeah.
So what happens is, people, Howard Marks has said that there are cycles. So in those cycle periods, there is a time to give an exceedingly optimistic view. And right now, the tone that we give in February 2022 is to give a view that you focus on asset allocation. And yes, over a 10-year period, always things will be good due to various structural trends in India and very positive demographics, structural growth story, good business cycle, etc. But valuations are not as cheap that one should put everything in one asset class. This is how we tell people, and people don't like to hear that. But then we find it easier to convey that, because then it protects us that at a later point of time, we can actually genuinely give a big buy call, and referring to what we have said in February 2022.
No, that's true. Let's talk about personal investing, right? You've been in the market for longer, and I've also read that the whole investing cycle, whole investing, your journey started in your home when you used to talk to your dad about this whole investing thing. How's your own personal investing side has evolved? Have you ever also personally looked at investing in any of those high growth tech names globally, or even now in India, some of them are getting listed, which is very off late now. How do you look at the whole thing? And especially, how have your behavior changed, your personal investing behavior changed in the volatile times?
It's become more conservative, maybe due to age, due to the fact that I have a special child, and it's become reasonably conservative. So I stick to mutual funds, particularly ICICI, and then happily I don't do all these complex, anything complex. I'm happy investing in mutual funds. And I found that, you will be surprised that these kind of things itself yield you very decent returns, given that mutual funds are a good vehicle to invest in. And so I have, but in 2012-13, the NASDAQ fund was available in India. And at that point of time, when I invested, and that I did Peter Lynn style after falling in love with my iPad. And at that point of time, no one wanted to invest in NASDAQ. Yeah. The NASDAQ in a fund which was available in India. But today everyone has fallen hell over heels investing in global funds. But now I'm much more measured, and I'm very happy with an asset allocation approach to global investing also, through a product that our company created called passive multi-asset fund of fund. But I believe that these kind of asset allocation models are good enough when market valuations are high. If there is a dislocation in the market and I feel the market is dislocated, maybe at that point of time I will go and possibly take a much more aggressive approach to investing. But right now at this level of the market, with global central banks having pumped $25,000 billion of money in QE, I'm happy doing asset allocation and being relaxed about it in the mutual fund format.
So talking about some of the growth names which are getting listed in India, and we have seen those also getting impacted in this whole global tech meltdown, especially in the high growth and loss-making, especially loss-making names. How do you see this whole sector evolving in India? And you have any suggestions for the investors who are looking at this sector itself?
I think we were lucky. First was that the first few companies itself, there was one which has fallen 50%.
Yeah.
Otherwise, we would have had 20 companies coming like that. And as mutual funds, and that too as one of the largest mutual funds, ICICI Prudential would have had a tough time saying not investing in many of them. So, and if they had all become successful. So I would say right now, after a few of them have come down substantially, we are in a better position to look at them more rationally, and investment bankers also have to come to us more rationally. But it's a challenge, I must tell you, because see, we are all used to looking at cash flows. We are all used to looking at profits. And everyone thinks every company in India will become a Google or a Facebook or an Amazon. And some of us, maybe with gray hair, believe that everything is not going to become a Google or a Facebook or an Amazon.
Yeah.
And that becomes a big challenge. So I do rely on my younger colleagues to give me a more positive view on many of these companies. And then we debate it out and we try to moderate their view. They try to moderate our negative view. So it becomes very interesting. But so far we have come out winner. But luckily, this derating which has happened in the last 2 months is a big support for us. Otherwise, I was very, very worried. 3-4 months back, I was very worried how this will shape up. Because if all loss-making companies have 1 lakh crore market caps, how do I run my funds with my kind of thought process? And I'm managing other people's money, so I was really worried. Luckily, things are improved.
You spoke about your younger fund managers, and I was listening to one of where you spoke about having a co-fund manager actually helps, especially you talked about yourself avoiding some of the biases all of us have. So how has this strategy played out for you guys in terms of having co-fund managers?
It's been brilliant for me because at the end of the day, you have to accept the other person's view and not say you are less experienced, you know nothing. Then it will not work. So you hear the other person's view, it gives you a lot of scope to think whether the other person is right or you're right. You have a little less time to look at things bottom up. You have much more gray hair and therefore more experience in terms of having cycles. So you mix your ability to look at cycles and having the experience of seeing longer periods of time of seeing managements with that person's knowledge of bottom up. The combination of the two has been of great help over a period of time and has helped in preventing mistakes. Particularly, the selling decision has been helped. There was a time when I used to sell too early and make a lot of mistakes due to selling too early. My co-fund managers helped me to slow down my selling decision and helped me create huge alpha in some of my, because I had a capability to buy falling knives, but I had a capability to also sell early. So my co-fund managers prevented me from selling early some of the winning stocks that I had bought correctly at the right time. So I would say that decision was completely due to whatever learnings I had from my co-fund managers. Having said that, I keep saying that fund management is part art, part luck, part science, and temperament is very important. It is the combination of all these things which lead you to winning, both as a fund manager and as an investor. People think it is only knowledge. It is not. It is this combination which is important. And if you get this winning combination right, you don't need to work in a mutual fund to make money. You can make money without working in a mutual fund. But maybe working in a mutual fund like ICICI Prudential helps you to learn these skill sets. So actually, this combination is what is needed for you to actually make money over the long run. And that's what, if you look at a 95-year-old Warren Buffett or even older Charlie Munger has shown us over this entire period.
True. Let's come to some, your personal life as well. And you've been very open about it. You just mentioned as well that you have a special child at home. Tell us about, what challenges that comes or, and how that changes you as a person.
See, actually, you tend to think less about your career. And when you think less about your career, you do better in your career. You tend to think less about money, so you can make more money personally. So, what happens is, I believe that you become little less arrogant about your IQ and your capability. So I think the combination of all these things are very, very helpful. And you recognize that the long run has more uncertainty, just like the market has more uncertainty. So maybe that helps you to take better investment decisions, because investment decisions are all about uncertainties. So maybe I would say that it's something which I found very difficult to say, but somehow it prepares you for life better, because investing itself is about uncertainty. I mean, as we speak in February 2022, would have thought that Ukraine will become such a big problem. If you had told me 6 months back that Ukraine would be one of the problems that we have to grapple with, no one would have known. But maybe because of all these things, you are more prepared for life's uncertainties, and you tend to think less in certainties. That is of great help. And of course, you have to recognize that in the Indian family system, the amount of work that my wife has done in this whole thing is 1,000 to 1 to what I have done. And that is the reason why I've been able to focus on my job, my investors, and the thrill that I get from looking after my investors has been possible only because of my wife focusing on this.
That's so true. That's so true. Our show is actually called Breaking Investment Stereotypes, and you've been actually breaking a lot of stereotypes over the years. But any particular one or two you want to talk about?
What do you mean by that question? I couldn't get it clear.
Yeah. So I'm saying our show is actually called Breaking Investment Stereotypes. Yeah, we all have a lot of stereotypes in our image, right, about many things, and especially about investing. And I think you've been, when you said contrarian, that itself is kind of breaking a little bit of a stereotype. Normally people go with momentum. Any particular one or two things you want to talk about, which is generally accepted norm, but you think people have to look at very differently?
See, I think there is a perception that you need to know everything to make money over a long period of time in investing. And that is not true. What is needed is a good temperament, and what is needed is basic common sense, and maybe one or two other people to reason out that common sense, and an ability to take right decisions at the right time. So if you ask me, this is not like if you read Howard Marks' memos over the last 30 years, he has not used the word price to earning, ROE, return on invested capital, any jargon in any of his memos. And frankly, if you ask me to make money in the markets over a 30 to 40 year period, you don't need to know everything about finance. But you need to have the right temperament, you need to have the right common sense, and maybe you need one or two people to debate a decision, and then you should have the ability to take the decision. Somehow that is what is needed. So in 2012, to buy US equities, after 12 years of US market doing badly, was very, very easy. And in fact, at ICICI Prudential, we launched the US fund. And no one was willing to invest in US at that point of time. For us, it was a very simple decision. 12 years of zero return in one of the best capitalist societies in the world. And markets were very, very cheap. And the companies in US were the best. So for us, it was such an easy decision. So the temperament part of it, the logic part of it, the common sense part of it was very, very easy. And if you looked at it in 2012, after 10 years of real estate doing well in India, and real estate in Bombay and Delhi and Gurgaon and Noida becoming so expensive, real estate in Bombay, Delhi, Noida, Gurgaon was very, very easy to know that it was very, very costly. So somehow people ignore common sense and think that investing is very, very complicated. It is not. It is simple logic and the ability to not do what everyone else is doing at that point of time. And maybe you need one or two other people to be debating with you and the ability to take that decision. So in March 2020, when markets crashed, to put some money to work was too easy. I'm not saying to put all the money because you would have not known what is COVID, but to put some money to work was not difficult at all. So I believe that, to take out money after a blistering rally from March 2020 onwards at 60,000 was not again very difficult. So I believe that, I think at 60,000 to practice asset allocation, which we came on TV and said, was not very difficult. Again, it was common sense. So somewhere investing is common sense, but to practice common sense is not easy. And this is our learning over a period of time. So when people do complex leveraging at wrong points of time in the cycle, they take complex short at wrong points of time. These are all things that have to be avoided. And so I would say investing is common sense, but common sense is not easy. That is what I would say is what my ending comments would be.
Yeah. Just last one question. This is what we ask everyone. What will you advise to your own 20-year-old self? So, someone 20-year-old comes to you for life advice. What will that be?
It would be that one, keep learning. Second is don't become too arrogant, and have humility built into you. And I believe that this quest for learning, I believe that you have to learn to be a better communicator. At the age of 20, I was a hopeless communicator, and I did not know how to deal with others. I think it's important to know how to deal with others, whether it is family, friends, bosses, subordinates, colleagues. It's very important how to know how to deal with everyone around you. And I believe that become a good investor by using common sense. It's very important to be a good investor than to worry about many other things in life. But people in India are not taught how to be a good investor. They are not taught how to be a good communicator. They are not taught how to deal with others in their life. They're taught how to do complex integration calculation, complex calculus, very many more things complex. But I would say these three skill sets: learn how to communicate, how to deal with people, and how to be a good investor of your own money, or how to plan your own finances. These are the three skill sets which help you in your life and which people don't have. Many people don't have. This is my life.
With that, we come to conclusion of our talk. Naren, thank you so much for your valued time. I really enjoyed the conversation. So thanks a lot.
Thank you. Thank you.